Explain to our audience how if we have a higher yield regime, you get a higher coupon, but at the same time, the portfolio's sinking like a rock. Which do you want, the coupon, or do you want portfolio stability?
I think we want investment to try and reverse that, because you've identified it absolutely correctly. And we're seeing people not living as long, and so there's a lot of changes going on in the actuarial world.
Right.
The solution to this is actually huge investment in infrastructure required, because we've created a 30-year infrastructure deficit in both the US and indeed in the UK, and institutions are sitting on all this money,
right,
which is what you've just said, Tom, is going to be absolutely the case, and they need to do something about it.
A lot of money, and maybe that's the social good that comes out of this, but what it comes down to is the math that you're expert at, and you go back as ancient as you and I are to the 1958 CSO table.
Yeah.
Do you know the math of the retirees to come? Do you have any confidence
in
our math of us getting aged?
Yeah,
Francine will forever be 29, but the rest of us get aged.
Yeah, she's looking even younger than 29.
Do we know the math?
We are very confident on the maths, actually, now, as to what the rate of longevity's decelerate. People are not living as long as people expected. That's a windfall gain for the corporate sector. Interest rates have gone up. That's going to help them in terms of reducing their overall deficit. Equity markets have gone up. So we're going to see a transfer of these large pension schemes into pooled insurance vehicles. Those pooled insurance vehicles will be able to invest in the real economy, real assets, with this deficit that we have in both the US and the UK in terms of infrastructure.
Right, but how much damage have negative rates done to those pension funds in Europe?
No, they have done damage over a long period of time, but actually we have to now step up and take a different medicine to solve it. It actually is quite fortuitous that actually the political will in Europe, the UK and the US is finally going to address the infrastructure deficit.
We both learned logs from Briggs of Scotland a million years ago, and what we know is there's no logarithms, there's no glide paths on negative numbers. Do you just assume, as Francine correctly identifies, as we come out of a negative rate regime, we come out with stability, where you just go quarter to quarter, still minting the 4% you need?
No, I think we are going to see more stability. Economic growth is happening all over the world. Secular stagnation is not happening. People are finally, the very famous words of Bob Solow, we're actually beginning to see technology in the numbers, which we couldn't see for a long period of time. The technology companies are doing a great job with technology, but business is finally beginning to understand and invest in technology to drive productivity. The biggest problem in Britain is not Brexit. It's absolutely not Brexit. It's the productivity difference between ourselves, the US, and Germany.
Okay.
30%.